Right, in this session we're going to talk a little bit about the weighted average cost of capital. My trusty sidekick behind the camera gave me a few tips about presenting, so hopefully this time you'll be able to see a bit better. Weighted average cost of capital is probably one of the key things you need to understand both for your midterm test, and you're going to use this going into your final exam, valuing companies. So try and spend a lot of time understanding the detail on what we're going to be covering here. WACC, that's how I'm going to talk about it. It's called WACC. So conceptually, what is WACC? I think the best place, and maybe to try and explain it, is if I've got something there, if I've got cash and I'm going to invest that. For example, if I borrow money and I want to invest it, if I borrow money and that money's costing me 6%, there's no ways I want to invest it in something that's going to earn me less than 6%, otherwise I'm making a loss. And similar thing, if I have my own equity, I could invest that in a just a cash unit trust or something else, just to earn me a very it's almost my opportunity cost of my cash. Or I could invest in something riskier. But the comparison I'm going to be drawing is, what else could I use my cash for? If I've got this 100,000 Rand, I could invest it in a unit trust. I could invest it in another project. And how do I know what's going to be the best way to invest that? And what the WACC does is it basically tries to capture the opportunity cost of your capital. So in a company or a project, what you'll have is you'll have equity and debt often used to invest in a project. So if I was going to buy a property and I'm running a property fund, what I'd do is I'd go to the bank and I'd get debt, and then I'd also go to equity investors and they'd give me cash. So what I need to understand is, what is the overall cost of that capital? The reason why is then I need to say, well, will the projects I'm going to invest in deliver more than that cost of capital? So WACC is seen as your opportunity cost of capital. And if I only had a project that was entirely funded with equity, then all I'd really need to understand on that would be my cost of equity. And similarly, if I use 100% debt to finance something, I would just be interested in knowing, well, what is the opportunity cost of that? And that would just be the cost of debt. So that just gives a little introduction to what WACC is actually meant to do. And the other ways of seeing WACC can also be the discount rate that you'll cover in order to value a firm. So let's not go there right now. But that's basically what the cost of capital is. And what we're going to do is, instead of, I'm just going to quickly run you through your slides and show you how I'm going to just tackle it slightly differently so that you understand this cost of capital and how all the various parts add up into the cost of capital. So let's just walk through the slides that you've been given. So it starts off with giving you the formula. We're going to go through this. I mean, what I'm going to do today is I'm going to start and we're going to go through the formula, explain it, and then we're going to go through calculating each one of the components, because I think that's where the WACC can get quite complex, is because there can be quite a lot of work that goes into each of the components. So there's estimating the kappa, the risk-free rate, yields. Yeah, man, we're going to tackle this bit by bit. But again, don't sit back on this one. It's really good to try and get involved in understanding this. It's really important for your course. Yeah, man. Okay. So we're gonna cover a lot of this, but we're gonna take it in a slightly broader approach, and we'll work into the details. So let's just start with the formula of WACC. What this formula basically says is the weighted cost of my capital, okay, will equal the weight of my equity times the cost of equity plus the weight of debt, well, this is just the weight of debt, times the cost of debt. What this also leaves off is preference shares, which are down here. And this is the formula you should learn. Don't worry about this top formula, because there's a high chance you'll probably get given preference shares as well. And some people learn the simple formula and we're unable to know what to do with preference shares. Don't worry what preference shares are for now. Let's just understand what makes up the WACC formula. Remember what the WACC is? It's the cost of your capital. So whatever capital you're bringing into either a project or a business, you really need to account for that. So in this formula, what we're saying is there's equity that we're bringing in, there's preference shares, there's debt. Those are the three components we're bringing in. So let's maybe start by understanding. We're going to go through each of the components. And we're just going to speak firstly about how do you calculate the weights. So just in the formula I've got, you can see I've just called it WE, WD, and WP, weight of debt, weight of equity, and the weight of preference shares. And it's the same as there. All the weights are simply saying is the weight of debt will equal the number of debt over what they call the firm value, V, which is basically all the entire capital that you're using. So debt plus equity plus preference shares. So this is all very simple. It looks great. Where this does get more complicated is often in the cases you're given a hell of a lot of data that you need to try and figure out, well, what would really be my debt figure, or what really would be the value. One thing to remember in this section is you often get book values and you get market values. Book values are sometimes in your accounts, all your debt and equity can be recorded at cost, and particularly a while back. But what we try to understand, and maybe more modern methods cater for it in accounting, is the market values. So you're trying to figure out, when you're doing your weightings, what is the market value? And then that's what you want to try and use. So for example, if I look at the debt, we're going to cover this all in an example at the end that we did for our midterm test. But let's just start with the equity. The equity the market value of the equity we're looking at is simply saying we take the number of shares we've got and we times it by the current price. And what you may find is you go through all your data and you say, great, I understand how to do that. How do I get the number of shares and there's no price? Just look out for things such as a PE ratio, price earnings ratio. Look out for when they say, oh no, these shares were issued at say a certain value at the initial price. What you can do is you may need to just to think about how you get back to calculating your each of those components. You can calculate the number of shares, for example, by taking, if it was a book value and they gave you the price that they initially listed those shares at, you can then just divide it and you'll get the number of shares. And then if you, for example, you wanted to calculate the price, if they don't give it to you, what you can do is look for a ratio that could have a price in it. The price earnings is basically the price of the earnings per share. So what you could do is they'll, in the information, we'll do it a bit later, is that they actually give all those components, and you need to just identify the current price. The overall objective of these is just to remember where we're trying to go. And with WACC, I think where people get lost is they forget this big picture. They forget what we're trying to do. We're trying to calculate the cost of our capital. So when we start getting into the detail, don't get lost. There may come a time in your exam where you need to say, well, I don't know how to do this section. What you should do is really write an assumption and then move on. Try your best, but don't spend hours getting stuck up on one of the inputs, because there's quite a lot you need to do to get to the WACC. And guaranteed, it's not going to be all the information given to you. You're going to have to try and back up some information. The weight of the preference shares, same thing. You can use They'll probably give you book values, and you need to calculate the market values on those. And it's quite simple. It's similar to the share. They may say to you, what's this example we had here? Preference shares, they're 8% preference shares, and they gave you a book value, and you had to work out the market value. So, just it all makes sense, but the weights, all you're trying to look at here is market values if possible. Otherwise, book values. Remember, if you're going to use book values, you need to justify. So if I didn't find a price for the way, even though they ideally want you to find the market value of the equity, if they don't give it to you, what you can say is, well, I'm using a book value because I've been unable to find the price wasn't given, and boom, write it down, move on. What we can look at now, maybe is a good place to start, is let me use my little pointer. So we've kind of just touched on what are the weights, looking at market values of each of the components. Now we're going to say what is the cost. So let's start with one of them. Let's just say here we've got the cost of equity, and from the information we've covered, just see here, there's only two ways to do it: the dividend discount model and kappa. Okay, this equals to RE. So that's what we're trying to calculate. There's two different ways to go about it, and often it'll be dependent on the information they give you in the case. In the book, there's also a fantastic description on the differences between them, and I'll touch on a few of them. But the dividend, let's just start with the dividend discount model. The formulas are all given to you, and they highlight that there's obviously a zero growth case. But let's just write out the formula for the constant growth, which is more realistic in most situations. Very simply, that's just your dividends in time, like time zero, times your growth divided by your price now. Then you add on the growth at the end. So what they may say to you is, they may give you like a growth in earnings figure, or you look for growth in dividends. Another thing they may say is, we've got a payout ratio of 50%. And so to get this dividends figure, they may not just say to you again, they may not just say dividend is R1.20 a share. It may, there's a couple of ways they could do it. But the key to remember is what you're trying to get. You're trying to get to that dividends figure. So one common way is to say, the payout ratio is 30%, and they give you a figure that your net profit after tax is 10 million. So how much are they actually going to pay out? They're going to pay out 3.3 million in dividends. So if you take that divided by, well, that's going to be the total amount. That's a dividend, 3.3. But if dividends per share, what you're going to have is you're just going to take the total dividends and divide it by the number of shares. Okay, great. So what we do is we get the dividends and we get the growth, and then you get a price now that you got for the share. And that will lead us to one method of calculating return on equity. Okay, this is called the dividend discount model, and it's one method of calculating the cost of equity. Okay, and this is a constant growth. You must remember that's quite important to understand, so we're using the assumption of constant growth in the dividends. A second way of doing this is to look at kappa. Now, kappa is we were speaking about portfolio theory, and kappa has come out of portfolio theory. And if we have time at the end, I'll maybe explain a little bit of how kappa is derived from that. But let's focus on, let's just assume now we start with the formula, and this is it over here. That's the first method, this is the second method of calculating cost of equity. One important thing to notice here is that the inputs are quite different in terms of what you need. So you need a beta, you need the return on the market, and you need a risk-free rate. And I guess that's one of the differences between these two methods, is that sometimes inputs for a dividend discount model can be easier to get, but in the context of your exam, it's going to be quite dependent on what they actually give you. So what you should be doing is look out for a beta. Look out for where they speak about government bonds. We're going to talk about why that ties into the risk-free. And then also look out for return on the market. Like the return on the market, they may give you an index. Index is something that tries to resemble an entire market. So it's a whole bunch of shares. We have the Alls in South Africa. There's a couple of indexes that can provide for a good representation of the market return. So we'll get there. But the difference is the kappa's risk. So sometimes you won't be able to get this information. But we're going to work through, if you do, how do you get back to the second method of cost of equity. Okay, so let's start. The one thing with WACC, and I just want to take you out one step. You need to first understand whether you're looking at a firm or a project. If you're looking at a firm, you must understand when you're doing all of this, you want to contextualize it to the entire firm. So if I'm looking at a firm and I start looking at the market values and weights, I want to be looking at the values that explain the entire firm. So the total debt in the firm, the total equity in the firm, the total number of preference shares in the firm. If I'm looking at just the project, then I actually want just the market values of our assets and information that links just to my project. So here I would be looking at just the debt that I used to buy that asset or that specific project and the equity. Okay, I just wanted to contextualize that. Let's just explain a little bit more about what kappa has done. We've said that there are kappa components. What you'll notice is the middle term, the expected return on the market less the risk free. This is called the risk premium. And it's basically saying how much more is the market expected to return above the risk-free rate. What we do then is we times this by, remember beta is the risk, so that's the risk of our asset, our project or our firm. And so we're saying we've got the excess risk of the market times by our systematic risk of our project or our firm. And that leads us, if we add that to the risk-free rate, to an expected return for the return on equity that we're looking at here. So quite important to just think it through, and you can understand how that could tie back to when we spoke about the efficient frontier. So we've spoken a little in the last session just about how to estimate the beta. While they may give it to you, sometimes they may expect you to calculate the beta using a pure play approach. which is where you're given comparable firms and you need to lever and unlever. What I'd really encourage you to think about when you're doing this is, have they given you a levered or unlevered beta, and what do you actually need to do with it? So sit down and actually think. We covered in the last session, and if you're confused, maybe just go back and watch that portion. But really understand in your head, because where finance, especially in these exams, can be tricky is with the information they give you. You know, it's not like accounts where it's one formula. You need to go into a little bit more detail to understand that if they give me 4 choices for an input, how do I know which one is the best? And that's often what will happen with the risk-free rate. With the risk-free rate, they may give you what they call a T-bill, so a short-term treasury bill. They'll give you a rate for that. They'll give you a 5-year government bond. They'll give you a 10-year government bond. They'll give you a 20-year government bond. And they'll say, well, they'll assume that you've got to pick one of those to be a risk-free rate. So how do you do that? Match the risk-free rate with the time of your investment. If my investment, if I'm looking at the expected return of a project over 10 years, what I want to do is to try and look at a bond or a risk-free rate that's actually also over 10 years. If it's a 20-year, look a bit longer. And why are government bonds risk-free? Well, the whole principle about them, they're not actually technically risk-free, especially the bonds, but the whole purpose of saying that is that the government doesn't default, or isn't supposed to. So if I buy the government's bond, I've got the backing of the entire government. Therefore, my risk is going to be substantially less. And if I bought a bond, which is, I hope you guys understand bonds. For those who don't, and I'm just going to take one step. If you don't understand what a bond is, if I've got a company and I want to raise money, so I've got a listed company, one of the ways I can do that is by issuing a bond where people buy that debt. So effectively as investors, we're buying a bond. So we're buying, we're basically we're getting a bond and we're giving the government cash. That's what we're doing. And they'll give us interest on our money. So that's quite secure. If I do it with a company, the risk of a company is a lot higher than the government. And that's why government almost seems to take on this risk-free role in context of kappa, because you're saying, well, their chances of them defaulting is a lot less. So what I would suggest is generally use a rate on this that is a bit, or matches your evaluation period. If they don't say, sometimes I think longer is better than shorter. Okay, so that's the risk-free look. Expected the return on the market. It really does depend on the context that I'll give it to you. Sometimes they'll say the market, sometimes I'll just say the market risk premium is X, and that would cover both of these inputs. Okay, and another thing they could do is say to you, well, the market risk premium is, say, 10, and the return on the market is 5. No, the return on the market is 20. So the market risk premium is 10 and the return on the market is 20. What is your risk-free rate for this? You may just have to work it back. So the 20 less than 10 gives you 10. So it's a really bad example because the return on the market is the same as the risk-free. But just understand the principle. What they'll do is that they may ask you, give you different ways in order to calculate this. Okay, that should provide a bit of context. And yeah, once you get the return on equity, that's this component over here. So you can see once we've got the return on equity, we've now talked a little about the weights, and we spoke a little about the two methods: the dividend discount model and the kappa, the capital asset pricing model. And those are two methods to calculate the cost of equity. Now what we're going to do is speak a little about the cost of debt, and how do you calculate the cost of debt? So, cost of debt. Right. With the cost of debt, again, start out by thinking quite logically about what debt is actually in this project or in this company. What we're trying to do is to find out if I had, say, 3 sources of debt, what is the cost? What is my weighted average cost on all of those sources? So, for example, they may use terms like debentures, they may use terms like bank debt or bonds. All of that is debt that I am effectively using to fund my project or my business. And the point of figuring out the cost is saying, well, I'm going to incorporate this back into my total cost of capital. So in other words, the total cost. So it can get confusing. In bigger companies, sometimes you'll have 10 sources of debt, and you've got to work out the cost of debt on each one, and then calculate your weighted average. The chances are, for example, may get two sources, maybe 3 if they're pushing it. But let's just start with bank debt, nice and simple. This is if I just go and get a loan from the bank, and they say to me, the interest is prime less 2% in South Africa. That is my cost of debt on that. Very simple, done, klar. And second one is they say, well, I've got a bond. And how do you, with the bond, and Chipa may have gone through this, what you need to do with the bond is there's a couple of components, and we're going to spend 5 minutes now just understanding how do you calculate this almost as cost of a bond. And there are a couple of inputs that if you haven't used your financial calculators yet, you may want to just check with someone on how to use them, because they really make this process a lot simpler. So what I said with the bond is, a bond is where, for example, I'm going to give the government money, and they, in return, they say to me, great, we're going to hold your money for 10 years, and we're going to give you interest, or what the terminology is a coupon of 4%. Coupons are generally paid semi-annually. Sometimes in your questions they won't specify whether, they'll say, okay, we've got this government bond, and the interest rate, sometimes they'll say the interest rate, for example, is 10% interest rate. Don't get confused. That isn't the cost of debt. That when they say interest, what they mean is, if I give you a bond, it's like saying I give the government 100,000, they say they're going to give me a 10% interest. That's just the coupon payment. So in other words, coupon. And then you also have the number of periods. So they say they're going to hold it for 10 years. And then you've got something called the par value of a bond. What the par value is, it basically says that what's the bond going to be worth right at the end, and it's generally 1,000 or 100, and they may not necessarily give you that figure. What you need to do is to realize that if they give you a price, so what we're going to look is it's kind of like a future value and present value. I don't know if you guys have done time value of money yet. So let's just call this the end price. And in other words, let's call it par value, or the future value. Basically, we're saying at the end, this is what the bond will be worth. And it's generally 1,000 or 100, and the way you will know is they may give you today's price. So they say that this bond was trading for 892 rand and 50 cents. Okay? So let's just understand this, because we're going to now punch this into a calculator. And what we're trying to do is, remember, we're trying to find on the calculator, it looks like that.